Good morning, everyone. Really pleased to welcome you to our quarterly update, looking at the latest findings from the Robert Half Jobs Confidence Index in partnership with the Cebr, or the Centre for Economics and Business Research. Today we have Chris Breen, Head of Economic Insight at Cebr, with us. He'll go through the latest JCI data for us, followed by a Q&A off the back of the findings. But before I start, I'd like to give maybe some reasons as to why we've commissioned this unique study. So business and consumer confidences are regularly measured, analysing worker confidence through a macroeconomic lens. And in the context of job creation, security and career progression, this can reveal deeper insights into the state and stability of the labour market. And although traditional measures of labour market health, like unemployment and job vacancies, are valuable, these figures alone don't really give us enough of an understanding of the UK's increasingly complex labour market. That's why we've partnered with the Cebr to create the quarterly Jobs Confidence Index. Keeping a finger on the pulse of current trends, employers can create a more purposeful talent acquisition and learning and development strategy, and job seekers and employers can make better informed decisions on how their goals are met around things like remuneration, work model and flexibility, as well as comparing skills and their progression and how these fit with the wider picture. So before I do that, I'd like to introduce Chris, our guest speaker, as I said, from the Cebr. He is the head of Economic Insight and is regularly interviewed on TV and radio. He also often presents his research at public events around the UK. He analyses and authors bespoke reports and comments on labour market trends. We're delighted Chris is here for us to talk us through the Robert Half Jobs Confidence Index. We've been doing this for over a year now, so we're getting some really good trends and insights over a long period. So without further ado, Chris, I'd love to pass over to you to talk us through the report.
Thank you very much. Yeah, absolutely. So I will start to present some slides and while they are loading, just to kind of reiterate what you said around the importance of this data set in terms of providing a more holistic view of the labour market in a way that any kind of singular data point just cannot. This is especially important actually given recent issues with the labour force survey, which is the source for most official labour market statistics. And indeed, what we have seen is that the ONS actually stopped producing labour market statistics for a number of months and continued to cite greater levels of uncertainty with official data than has been the case previously. So all the more reason, all the more importance to look at various sources of data and have a more holistic view than just relying on any single data set. So very timely production of this index. So we will start with looking at the JCI as a whole. It increased to 51.6 in Q2 2024. This is the 15th consecutive quarter in which it has been in positive territory, and it was up by over 5 points from the previous quarter's reading. The index has now increased for 2 consecutive quarters and has reached its highest level since Q1 2022. So of its 4 constituent pillars, which you can now see here, all 4 of them stood in positive territory this quarter. The job security pillar recorded its highest level among all of the pillars. 2 pillars showed higher readings compared to the previous quarter, which you can see by the green arrows. This is the pay confidence and the macroeconomic confidence pillars. In contrast, the job security confidence and the search and progression confidence pillars saw a decline. So now we'll go into each of the pillars in turn, starting with the job security confidence pillar. This decreased in Q2 from its record high last quarter. However, it still remains the strongest out of the 4, and this reading is the second highest reading on record, so still very high. The decline was primarily driven by an uptick in temporary work levels. But the unemployment rate stood at 4.2% in Q2 2024. This marked a 0.1 percentage point decline from the previous quarter, but actually also marks a 0.2% percentage point decline from its recent peak. Similarly, labour market tightness was broadly unchanged, as the slight decline in unemployment was matched by a continued decline in vacancies. Vacancies fell by around 30,000 in Q2, bringing the total to just under 900,000. This marks the 24th consecutive period of falling vacancies. Nonetheless, vacancies remain at a level that is above where they were pre-pandemic. The levels of temporary work increased during the quarter after declining for 2 consecutive quarters. This increase, again, was a key factor driving the overall decline in the job security confidence. However, employees are increasingly confident about their job prospects. So we surveyed just over 1,200 UK workers, and this time around, 61.4% of them expressed confidence in their job security over the next 6 months. This increased by 1 percentage point from the previous quarter. This is the highest level of confidence in this metric since Q1 2023. Moving on to the pay confidence pillar. This experienced the strongest quarterly gain among the 4 pillars. Indeed, the pillar moved out of negative territory in Q2, driven by improved pay gaps and jobs earning security. So annual pay growth stood at 4.5% in Q2. This is down quite markedly from 5.9% in Q1, marking the slowest growth rate since the 3 months to November 2021. However, what's really important is to look at real wage growth, which is wages minus inflation. And here, inflation, real wages were 1.6% in Q2. This was a slight slowdown on Q1, but nonetheless, still is a robust rate of growth. Elsewhere, our measure of pay variance, which considers the average pay deviation of pay within UK occupations, improved this quarter, while jobs earning security saw an increase as well. These improvements contributed to the overall enhancement of the pay confidence pillar. On a more negative front, labour productivity, here measured by output per hour worked, fell by 0.3% on an annual basis in Q2. This maintains the same rate of decline as seen in the previous 2 quarters as well. This is quite important because theoretically, over the long term, productivity is the single driver of real wages and therefore standards of living. So it is quite a negative story in amongst otherwise quite positive data around pay. Moving on to job search and progression. This also saw a decline. What we've seen is that part-time work, involuntary part-time work picked up a little bit, but remains still pretty good by long-term standards. Economic inactivity rates remain pretty high. Whilst if you look at job search confidence, this remains pretty strong over, and this was confidence measured by, again, survey of workers. This remains pretty positive. So I've skipped ahead slightly to macroeconomic confidence. But yes, generally, job search and progression has eased back slightly, but remains quite positive overall, still in positive territory. Moving on to macroeconomic confidence, this has increased for now 3 consecutive quarters. The trend reflects improved growth prospects and positive sentiment following the Bank of England's first rate cut in almost 5 years. The macroeconomic confidence pillar rose to 31 points, and it firmly sits in positive territory, representing the strongest score for this pillar since Q1 2022. It's primarily made up of two different trackers. The first one is a consumer confidence tracker, which we produce alongside YouGov. This is the strongest quarterly reading since Q4 2021 and averaged 109.4 in Q2, where a score of 100 reflects a historically neutral outlook. There's a notable increase in household finances confidence, which is likely linked to the ongoing improvements in real wages, which I've just mentioned. Meanwhile, looking at business optimism, this also rose in the quarter and exceeded the 100 threshold for the first time since Q2 2022, meaning that businesses are now overall optimistic by historic standards. The improvement was largely seen in April for both manufacturers and services firms, and that enhanced optimism remained throughout the rest of the entire quarter. This is likely linked to an acceleration in growth that was experienced during this period. And indeed, I think a lot of positive economic news about the improvement in the economy was seen around this April period. So that's looking at the four pillars which make up the JCI. But we also now do a hot topic, and this deep dives into one particular aspect of the labour market every quarter. This quarter, we decided to look at the New Deal for Working People, which is the name given to a set of pledges which were featured prominently in Labour's manifesto, and indeed also featured in the King's speech as the Employment Rights Bill, which is expected to be put in front of Parliament this autumn. The objective was to ask workers about their thoughts and their experiences in relation to various aspects of the proposed changes, given that the media narrative so far has largely been dominated about the views of business on this topic. So we wanted to provide the slightly different lens from the employee side. So again, like the two aspects of the JCI, which come from a survey. This hot topic was based on around 1,200 UK workers drawn from a representative sample of adults who responded to the survey. So we find that on net, around a third of UK workers anticipate the New Deal to positively impact their daily work. This is made up of 40% who saw a potential positive impact, 9% who said that they saw a negative impact. So the net balance for that is the 40 minus the 9, which gives you 31%, which is just under a third. However, the most common response was actually indifference. So 44% of people responded that they expect to see not much change in their daily work from the New Deal. However, looking at the different age profiles, younger workers, so those aged 18 to 34, had a much more positive view of the New Deal than older workers. In fact, the share of younger workers expecting a positive impact was twice as much as older workers. And by older workers here, we mean age 55 and over. Conversely, the majority of workers aged 55 plus believe that the New Deal would not impact their daily work, which, given that older workers tend to would expect to have less of their careers remaining than younger workers, this doesn't seem that surprising. On a regional basis, London workers were the most optimistic, with 50% expecting a positive impact, while workers in the east of England were the least optimistic, with less than a third expecting positive impact. But diving into the New Deal and the various proposals within this in a bit more detail. We selected various proposals within the New Deal and asked workers which of the following benefits they were likely to be seen as beneficial. And the most beneficial was the provision of day one rights around unfair dismissal, parental leave and sick pay and things like that. So 20% of workers selected that option. It's worth noting that actually the field period for this survey was before the press that we saw in the last couple of weeks regarding potential changes to day one rights around flexible working. So it may be that that percentage might have been even higher had we asked that question again now. But overall, people selected an average of 1.7 out of the 9 proposals that we put in front of them as positively impacting their own work life. Only 25% said that none of the proposals would have a positive impact. We separately asked for a subset of the proposals outlined in the chart. Yeah, this is the question that you can see in the chart. We asked if workers were actually already offered various aspects of the New Deal already by their employers. And as you can see, the most prevalent was wages not based on age, followed by no 0-hour contracts. But what I found very interesting from this question is that over a third of employees were not sure if various aspects of the New Deal were already offered to them, including 40% who didn't know if there was a menopause action plan and 39% who didn't know if their company published gender pay gap figures. Indeed, those figures didn't vary that much between genders either. So that's a snippet of what we learned about perceptions around the New Deal. To end up kind of this section by looking at kind of the forward-looking outlook for the economy. So the economy as a whole grew by 0.6% in Q2. This alongside the 0.7% growth we saw in Q1 marks 2 consecutive quarters of robust growth following the technical recession at the end of 2023, indicating that the economy is recovering robustly. However, if you look underneath the bonnet, actually, there's still a lot of weak spots within the economy, which are quite evident by the data. So business investment continues to fall, and consumer spending in Q2 this year remains below where it was in the same period last year. And actually, other aspects of the economy, such as government spending and net kind of capital formation, those were the drivers of the growth that we've seen this quarter. Inflation on the consumer price index increased to 2.2% in July. This is the first rise this year, and takes us back above that 2% target for the first time in 2 months. This was largely driven by changes in energy prices. But despite this, there are signs of easing price pressures throughout the economy. So this is reflected in core CPI inflation, which excludes energy prices and food, things which are seen as more volatile, but also are more set by global markets as opposed to domestic ones. So therefore, the Bank of England have less control over those prices. So looking at core CPI, that dropped to 3.3%. And that's the lowest level in nearly 3 years. So it's an important measure that the Bank of England will look at. Additionally, the slowdown in earnings growth that I've already mentioned has helped to ease services price inflation, although it remains elevated. Nonetheless, the direction of travel is such that the Bank of England felt comfortable enough to implement their first rate cut last month. And given the recent data, we expect another 1 rate cut this year, followed by another few rate cuts over next year. We expect that overall the bank rate will reach around the 4 to 3% mark in the medium term. So we don't expect that we'll end up in that kind of ultra low rate environment that we were in immediately prior to the pandemic. So looking ahead, we expect that the economy will grow at a similarly steady pace for the rest of the year as we have seen the start of this year. So overall, we expect a growth rate of around 1.2% this year. That's a large improvement from the 0.1% that we saw last year. And then growth will pick up further to 1.6% in 2025, but after that, we don't actually expect to see much more improvement. So we estimate that the trend growth rate for the economy is roughly around the 1.7% mark at the moment, which is really quite sluggish by historical standards. You know, it really is kind of return to normal, but that normal is a similar pattern to what we saw pre-pandemic, which is pretty sluggish rates of growth, driven by, as I've already mentioned, falling or quite poor rates of business investment growth, and falling and or kind of sluggish rates of productivity growth. So I'll leave it there. I'll stop sharing and hand back to Chris L.
Great, that's really interesting findings there, Chris. So thanks for taking us through that. Be great to ask you a couple of questions off the back of your commentary, if possible. So I think the first thing to ask is, what really are the key reasons for the increase in job confidence in your view?
Yeah, so I think there's probably a number of key things going on this quarter. I think number one, we got some data out last month that the unemployment rate had fallen, and as well, there's a lot of kind of positive news around the economy as a whole. So as I mentioned, growth has picked up quite markedly, and people are seeing that. They might also be seeing it across the businesses that they operate in. That they might be seeing that things have picked up more generally. Revenue might have picked up. Definitely not the case for all industries and all businesses, but very much the sense is that on average businesses are performing or are prospering a bit more. So the worker will be the average worker will be seeing this on the news. They will be seeing that maybe in their day-to-day role, and I think because of that they'll be feeling more confident, and that the recent increases in unemployment might be behind us, and that the economy as a whole is a bit more on a steady footing, and that's probably leading to this improved jobs confidence.
Yeah, that makes sense. You mentioned unemployment falling. In your view, then, does that mean that the labour market is now tightening up again?
Yes, it's a tricky one to answer, really. So as I've mentioned before, up front, actually, the ONS have got a bit of a health warning on their own data right now. They say the number of people who fill out the surveys, which then determine the unemployment rate, have fallen over a long period of time, and there's been a lot of volatility. So they themselves say don't pay too much attention to any one singular month of data. So I think it was a bit of a surprise to economists to see the unemployment rate fall this month. We were expecting maybe a little bit more of an uptick, or maybe for it to remain kind of where it was, which was at the kind of 4.4% mark. So it's a bit too early to tell. I wouldn't read too much into that one particular month of data, but nonetheless, I think what we were expecting is that we were already kind of near the peak, and we might have peaked already. It might come in the next couple of months, but we're kind of near enough there now, and we do expect that over the kind of the latter months of this year into next year, we will expect to see the labour market tighten again, and that's even at its peak of loosening that we've seen, it still remains pretty tight. So I think we'll still be talking about a very tight labour market, skill shortages. I don't think those major themes are going to go anywhere soon.
Yeah, no, I agree. And moving on, talking through wage growth. Wage growth is still above inflation. What's your view or prediction going forward for the likelihood of even further wage growth?
Yeah, so as I mentioned, at the current moment, it's around 4.5%. you expect to see a little bit of an uptick in the short term from public sector pay, given the kind of pay awards that we've seen made with in various industries. It remains to be seen if that leads to further pay awards or if it is kind of, a one-off bunch of awards. But nonetheless, that might have a little bit of a trickle through to the private sector and elsewhere. But nonetheless, I think that might be a temporary kind of increase. I think the general trend is still a gradual a downwards trend in growth. I think if you look at expectations on the business side, it's for somewhere around the kind of 4% or maybe high 3% growth rate for the next year. And indeed, we asked employees for their expectations last quarter, and they were even lower. So I think, employees and employers alike do expect a gradual decline in growth over the next year in wages. Nonetheless, we expect wages to remain pretty elevated compared to historical standards, but also we expect that wages will remain higher than inflation for the foreseeable future. So that is obviously good for the average consumer. They should expect to see a gradual improvement to their finances. And that's really driven by the continued tightness of the labour market that we've already mentioned.
Yeah, makes sense. And it was great to see the insights gained from employees. As you said, the media have been very focused on the business impact on the new deal for working people. So you've obviously done some great research and got some good results from that. So now we've got a more holistic view. What do you think we've learned about the new deal for working people?
I think there's quite a few different interesting elements to the findings around the New Deal. I think probably for me, the most startling was just how large a percentage of people didn't understand the benefits that are already offered to them, or if certain things were offered to them or not.
Yeah.
So I think that's quite an interesting one, and there may be two kind of trends of thought in terms of what that means for the New Deal. You might think that actually its impact might be lessened if improved rights are not actually taken up by workers because they don't know that they're there. But the other hand, you might think that actually putting those rights into law and making them standardized across all employers means that people might be more there might be more knowledge that those are on offer. But it also means that actually there's more that employers can do to make sure that people are benefiting from the benefits and rights that are already offered to them. But also plenty for the employees can do to make sure that they are also aware of those of those benefits. So I think there's a bit of a job to do to kind of increase that awareness. I think it's also quite interesting, to know that younger workers are pretty positive on the whole. Only a quarter of people didn't expect there to be any improvement from one of the kind of proposals that are in there. So
Yeah.
I think the pretty you'd expect a pretty positive impact, but I think what might be slightly concerning is the fact that on the whole people looking at the New Deal were more likely to be apathetic than positive about it. So again, that might be again a lack of awareness about what that would mean, about the benefits are in there. And you may expect to see a little bit more. We've already seen a bit more information come to light around what that might mean for flexibility, for workers, etc. So yeah, I think more awareness building to be done on the New Deal itself, but also on existing rights and benefits that workers have access to.
Yeah, I think the government are also focusing on skills at the moment. So how do you think that will help UK and the low productivity readings that we're seeing? Because I think the government are also saying that the New Deal will actually increase productivity through giving more job security to people. So what's your view on their focus around skills and that?
Yeah, I think the it remains to be seen on if the New Deal will actually improve productivity. I think it's still not really understood actually how hybrid working or working from home has impacted productivity. And there's people have I think views on either side, and normally quite entrenched views, but actually the real kind of solid evidence is still lacking. So I think there's still work to be done and research to be done to really understand what that means, and that will probably impact therefore on how the New Deal and potential changes to flexible working might improve productivity or not. But I think the more general focus on skills is absolutely vital. Um, I think theoretically what improves growth over the long term is productivity. What either kind of productivity, so how much input, how much you get out of your kind of inputs, or it's the level of inputs that you actually put in. So, the level of capital that you put in, or the level of the labor that you put in. Well, we know that we don't want a high immigration economy. I think politically that's quite clear,
Yeah,
and the government is trying to move us away from that. So, over the long term, we can't expect to kind of see we did see mass migration last year, but I don't think that's the kind of the model that the government want to pursue. And again, we're kind of struggling on the capital front as well. Investment is falling, and there's always a constant struggle for kind of foreign direct investment. But you can't really bank on kind of suddenly having a big influx of capital. So really, the primary focus for government should be around increasing productivity and getting more out of the kind of the labour that you already have. So that is absolutely the right approach. As I've mentioned, productivity growth has been really poor, not only in the last year, but actually since the financial crisis. It's not only a UK problem. We've seen it across much of the Western world, but actually the UK does suffer particularly poor productivity levels, compared to the likes of France, Germany, US, etc. So it's
yeah,
there's a lot to do. Skills, I think a big part of it are skills mismatches. Is the education system really producing the skills that are needed for what the economy looks like now and what it will look like in the future? Even down to things like careers advice. Or do kind of people actually understand the options that are available to them?
mm,
Before choosing their academic path, or actually if academia is the right path for them. I think recent changes like T levels will be really positive once they're kind of up and running fully. But any kind of changes to the skill system will take a lot of time to feed through, particularly the education system. I think another a key thing that the government can look at is adult skills, and looking at making more flexible relearning kind of reskilling systems. So people, your kind of skill set doesn't have to be flat once you've kind of come out of uni or come out of or whatever kind of initial qualifications you gain. That actually, given that the economy is ever developing, fast paced, we're kind of developing new skill sets all the time. We can make sure that that's aligned to the kind of the skills that people not only are coming out of kind of college or university, or kind of wherever else is, but actually they can change throughout their career, upskill and reskill as well. So I think, yeah, absolutely important for the government to look at this, and I think it will be really key for the long-term health of the UK economy as a whole.
yes. And low productivity is clearly a risk to business, but what do you see the other risks, and also the opportunities for businesses, especially maybe the small to medium enterprises? What do they need to be looking out for in the next 6 months?
Yeah, so I think risks for the economy as a whole would be that again the direction of travel in terms of inflation, wage growth seem to be downwards, which is the right path. But we're not there yet. We're not out of the woods. So, while we expect to see interest rates decline over the next kind of 6-12 months, as I've mentioned, it's not necessarily the case that that will happen. Definitely shouldn't be kind of assuming that path will happen. Should definitely be keeping an eye on it, keeping up to date with what the Bank of England is saying and doing, and how kind of wage growth and inflation as a whole are going along. I think obviously main risks that we know about right now, geopolitical, obviously kind of around the Middle East, around, Ukraine, Russia, that we continue to see geopolitical impacts on the supply chain. We continue to see, potential worsening of those conflicts. Keeping an eye on that. There's also, potential risks of kind of tensions, inflamed tensions between, the likes of China, EU, and the US. Potential change to the government in the US as well. Obviously things like EV, EV kind of import export from China is a particular sore point. That could lead to, potential new trade wars, etc. So, does that mean new tariffs on trade? Potential, again, supply chain impact. So, I think looking kind of externally from the UK, I think those are the things to keep your eye on. Internally to the UK, I think, again, understanding that probably the best case scenario is pretty weak growth. Understanding that we're not out of the woods in terms of inflation, and obviously, I think the key one would be the upcoming budget. Obviously, the government have been at pains to note the financial fiscal pressure that the economy is under, and that they're going to have to raise taxes. We know which taxes they're not going to raise, but we don't yet know which ones they are going to raise. So I think obviously we can expect to see probably some negative impacts on kind of the economy or the business as a whole from the budget, just based on what government have been telling us.
My final question was going to be around the budget, actually. So anything else you haven't already mentioned from the budget that you expect to be announced?
Yeah, I mean, it's pretty difficult. I mean, they haven't announced too much in terms of what they might, but I think you can read between the lines in terms, they're quite quick to say what they're not going to do. So, you can kind of infer what you think they are considering. So, definitely they're probably looking at capital gains tax. I think the key question is how much of an increase that will be. And I think, the rate of increase or the amount of increase in capital gains tax is probably quite important for what that means in terms of behavioural changes from that. If there's a few percentage points versus, kind of 10 percentage points, would have, I think, quite marked different impacts in terms of what that means. Inheritance tax has come up quite a lot in terms of potential changes. It may be, they're looking at the actual rate of inheritance, or it may actually be kind of getting rid of some of the reliefs to mean that more people actually have to pay it. They've said that they're probably not going to increase corporation tax. That's probably one thing that we can take off the list. But yeah, I think those are potentially, I think, they're probably the key things that they're probably looking at. Fuel duty is probably one that we might expect to see an increase in. I think obviously governments have been quite hesitant to increase duties in the past, but given I think even kind of bodies which normally would lobby for a freeze have said that a duty rise might make sense this time around. Gives government a bit more leeway to go ahead and do it. So those are the kind of few things that I think look quite likely, but again, remains to be seen what comes out of the budget next month.
Brilliant. Well, Chris, that's great. That's all we have time for this quarter. For anyone listening, please take a look at the report, which you can find on the Robert Half website. If you'd like to discuss in more detail some of the findings, then feel free to get in touch. There will be another webinar in a quarter's time where we'll look at Q3 results, and I'm sure they will have changed again. I'd like to thank you, Chris, for your time and for CBR for helping us with this, and we really value your partnership and look forward to our next quarterly catch up. So thanks, everybody.